Hello, welcome back to this week's market update. Today is Monday, February 23rd, 2026, and we'll jump right in. Looking at last week's market performance, stocks rose despite the weaker than expected GDP print, sticky inflation, and a Supreme Court decision striking down many of President Trump's tariffs. As of Friday's close, the Nasdaq Composite gained 1.28%, the S&P 500 1.12%, and the Dow Jones Industrial Average up 0.35% last week, reversing the prior week's trend of the value-heavy Dow outperforming the more growth-tilted indexes. Shifting gears into our market news from last week, Friday morning brought a long-awaited Supreme Court decision on the legality of several tariffs imposed by President Trump. In a 6-3 ruling, the court struck down the sweeping tariffs enacted through a series of executive orders over the past year. The decision did not address whether or how the federal government should provide refunds to importers that previously paid the tariff. So a bit of confusion still about how that will work out. Later in the day, President Trump expressed his disagreement with this ruling and announced a new executive order imposing a global 10% tariff, which was later increased to 15%. Now, what we're mainly looking for in developments like this is how the market was reacting. You can see Friday's chart here. We had the market up just about 0.7% on Friday, so market didn't really seem too phased, but we are getting some shakiness this Monday morning as we start off the new week. Also, last week we had several pretty important economic data prints. So, first, taking a look at PCE inflation data for the month of December. Headline inflation came in at 2.9% there, so a bit of a uptick. Core inflation also rising to 3%. Now, markets were anticipating a modest uptick, but the data does little to strengthen the case for some near-term rate cuts when the Fed goes to meet in March. Currently, futures markets are pricing in just about a 6% chance of a cut next month, and expectations have moved back further from the spring into the summer, currently expecting a rate cut around June based on current market pricing. With the PCE inflation data, we also get some great data on personal income, spending, and saving. Personal income rose 0.3% in the month of December, while personal spending rose a greater 0.4%, marking another month in which consumption growth outpaced income growth. As a result, the personal savings rate declined to 3.6%, extending this gradual downward trend that we've been seeing for quite some time. Overall, it was a pretty stable month, but interesting to see where the personal savings rate goes from here, as it has been on a pretty stable and slow decline. Moving along in our week, we also got fourth quarter GDP print coming in well below expectations at 1.4% compared to expectations closer to 3% for Q4. The primary drag came from a sharp decline in government spending, largely due to the federal shutdown that took up most of the fourth quarter. On the other hand, though, consumer spending was a very significant positive contributor to the quarter, as well as improving investment in businesses. Slight decline coming from lower exports, but we did get a slight boost from imports there. Now, it does seem that the quarter is very distorted by the sharp decline in government spending, so we'll have to see how that plays out in the coming quarters now that we are no longer in a full shutdown. Last but not least, the Conference Board's leading economic index here continued to decline in December, extending its prolonged slide. Although the index's rate of change no longer signals a recessionary signal, the headline level does continue to drift lower, so we'll take a look at some of these components here. Now, subtracting from the index, we had average consumer expectations for business conditions, as well as new orders, and average weekly manufacturing hours that has been pretty volatile in recent months. On the other hand, the building permits there, that was a positive contributor. Increasing building permits has been helpful to the index there, as well as stock prices and the slowly but surely de-inverting yield curve. Overall, the LEI continues to send a cautious signal, though current economic data suggests that the index may be a bit of a less reliable indicator in this cycle than it has been historically. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.